Compare that to the 1031 exchange. 1031 exchange does do tax deferral, and it does allow you to buy investment real estate, but it doesn't give you a new depreciation schedule, and it doesn't give you optimal timing. So the biggest one is optimal timing. If we generally know, Dwaine, as commercial real estate professionals, and so do your listeners, we generally know when it's a seller's market and when it's a buyer's market, right? And given enough time and given enough space and margin to look for deals, we can find deals in any market. But the challenge becomes when you're faced with that 45 identification period and 180 days to close. Or even when perhaps day 170, all of the properties fall apart, it doesn't work out, the lender won't lend, the seller won't deal, and you just don't want to overpay for that property, right? And so the Deferred Sales Trust solves that, in that we don't have to move the funds into like-kind property. You can put it into stocks, bonds, mutual funds. And then the key is you can invest it back into commercial real estate at any time, meaning tomorrow, day 181, or 5 years from now when you find a deal.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Brett Swarts. Brett is the founder of Capital Gains Tax Solutions out in Northern California. Brett is also the host of Capital Gains Tax Solutions with Brett Swarts, as well as being a real estate investor and multifamily broker. Brett, thank you so much for coming on the show. I really appreciate it.
Dwaine, it's my pleasure. Thanks for having me.
Yeah, I'm really excited to talk about this subject, as we kind of mentioned in our previous calls, as well as the pre-call, that we have a division that we handle single tenant net lease brokerage. So I work with a lot of 1031 exchange investors. So I'm really involved in, as far as like kind of like knowing kind of like the basic nuances. I'm not a tax expert by any means, but this when we had the discussion about deferred sales trust, which was kind of just blew my mind as far as kind of the possibilities. And now I'm like thinking back as far as my clients, and I can say this is going to be very valuable to them. So I'm going to be coming off as far as kind of like my questions, as well as maybe questions that they may potentially have, and hopefully have a nice, really fruitful conversation. But before we kick things off, would you just mind, I know you have a pretty elaborate background, would you just mind just telling the audience a little bit about yourself and how did you get started with your company?
Yeah, thanks, Dwaine. And yeah, so I'm originally from the Bay Area, Mission, San Jose, Fremont, California. My dad was a real estate contractor, developer, and so I grew up kind of the sticks and bricks of real estate, learning about it, owning rentals, seeing how they would manage cash flow and buy deals. And fast forward, in college, I studied business. And I also took an internship at a company called Marcus & Millichap, where I learned the investment real estate side of brokerage and helping people. In particular, I focused on multifamily apartment complexes here in Northern California. And along that journey, I learned about a different strategy, that most folks hadn't heard about. And so that's the Deferred Sales Trust. And more personal level, still live in Sacramento here, kind of where I grew up. Married with 5 kids. Played basketball in college, love playing hoops. That's my passion for hobby. When I have some free time, we have 5 kids, and so we stay very busy and active there. And my wife's really the rock star when it comes to that. And so we're just fortunate enough to be able to have healthy kids and have family around to support. So yeah, that's a little bit of the personal side.
Awesome. Yeah, so just kind of talking in regards to the deferred sales trust, but before we kind of dig a little bit deeper into that, regarding like kind of 1031 exchanges, I know probably the 500 level view of it, but can you kind of explain for that, especially people who are new? I know I have a lot of investors and clients that own property that haven't made a sale before, but maybe kind of explain that process, and maybe we can go a little bit deeper into other strategy of deferred sales trust.
Yeah, most commercial real estate owners know about the 1031 exchange, and because they struggle with capital gains tax, and they're looking for a deferral mechanism to create and preserve more wealth instead of paying that 30 to 50% to the government. So the 1031 exchange is simply an opportunity to trade like-kind investment real estate for like-kind investment real estate of equal or greater value, there's some rules you need to follow, such as identifying properties within 45 days and then closing on 1, 2, or 3, or depending on what rule you choose, of those properties within 180 days. And as long as you follow those guidelines and you send the funds to a qualified intermediary, you've perfected a 1031 exchange, and therefore you're in a deferral state. So most commercial real estate owners know about that. But 20 years ago, when it was kind of getting popular, not a lot of people did, and it was still new to them. And that's sort of what we feel right now with the deferred sales trust. Although we've been doing it for 23 years, most people still haven't really heard about it, or if they have, it has been put in a clear way where they can see how it applies to them and how they can really create and preserve more wealth with it.
Exactly. Yeah. Especially like I said, it's not a lot of, I say, broad in information, probably more so on the 1031 exchange because, more people are kind of working on that stuff. Is more easier to digest. Regarding the thing that you had mentioned is regarding the rules. That's kind of the biggest struggle is I sometimes will get a call from investors saying I have, my property is under contract. So we have, 30 days to close of escrow. Then we have our 45-day clock starting. But in some call, they're in that process where they have to ID a property, and we're kind of stuck where they're looking at, a bunch of opportunities, and we end up looking at stuff that, if they had more time, they probably would have waited to see if there's an optimal time to purchase that asset. But in certain times, just because they're in exchange, they feel that they kind of have to do something in order to avoid paying the taxes. Can you kind of elaborate as far as kind of like the benefits of this diverse sales trust? And we'll get into kind of the additional nuances, the kind of the flexibility and stuff as far as using both of those strategies.
Yeah, and so back to the premise, most commercial real estate owners or even business owners, they struggle with capital gains tax when they go to sell their highly appreciated asset. And we use a deferred sales trust to give liquidity, diversification, tax deferral, and the best thing is optimal timing, the ability to buy back into real estate at any time, all tax deferred, with a new depreciation schedule so they can create and preserve more wealth. So let's compare that to the 1031 exchange. 1031 exchange does do tax deferral, and it does allow you to buy investment real estate, but it doesn't give you a new depreciation schedule, and it doesn't give you optimal timing. So the biggest one is optimal timing. If we generally know, Dwaine, as commercial real estate professionals, and so do your listeners, we generally know when it's a seller's market and when it's a buyer's market, right? And given enough time and given enough space and margin to look for deals, we can find deals in any market. But the challenge becomes when you're faced with that 45 identification period and 180 days to close. Or even when perhaps day 170, all the properties fall apart, it doesn't work out, the lender won't lend, the seller won't deal, and you just don't want to overpay for that property, right? And so the deferred sales trust solves that, in that we don't have to move the funds into like-kind property. You can put it into stocks, bonds, mutual funds. And then the key is you can invest it back into commercial real estate at any time, meaning tomorrow, day 181, or 5 years from now when you find a deal. And that's really the key to this. But my journey is back in Marcus and Millichap. I saw in Sacramento particularly, it was one of the hardest hit cities in America for the crash. It was a huge boom and then a huge crash. And so in the 05, 06, 07 market, a lot of people were trading properties in 1031 exchanges, and they're really happy to get that offer, let's say for $2, $3, $4, $5 million. And they're excited to be a seller, but then all of a sudden they had to turn around and be a buyer. Why? Because they felt they had no other choice except to defer the 30 to 50% in gain. And so what happens is you end up, generally speaking, what can happen is you end up overpaying for a property. So the first thing is optimal timing and overpaying. The second thing is taking on equal or greater a value, which oftentimes means equal or greater debt. Okay, and that's where people really got hurt in the 08 crisis, is really how much they were over leveraged and they overpaid, and they didn't find value add deals, or perhaps in your world it was single tenant assets where the corporation just went bankrupt and they had no one to pay the rent, right? And it's a single tenant, so they weren't diversified. The deferred sales trust solves that in that we pay off all the debt at closing, and just the proceeds go into the trust. So we call it the debt-free plan for your commercial real estate or business. And now the proceeds are sitting in liquid, diversified portfolio. And the diversification can be multiple things. It could be multiple commercial real estate syndication deals. It could be multiple commercial real estate deals that you buy on your own. And it can also be stocks, bonds, and mutual funds of your choosing, which creates an opportunity, again, to diversify versus being in a single asset in a single location and typically a single product type, which, as we also know, the United States there's different markets, and some places are buyers markets, some places are sellers markets. It's ever changing. It's not just everything's a seller's market and everything's a buyer's market. Although generally speaking, we would say it's more of a seller's market today more than ever. But that being said, if you can diversify, let's say a $5 million asset into 3 or 4 different product types with different geographical locations, and have the timing is unlimited, you give yourself a competitive advantage to find the right deal so you can create and preserve more wealth. So I'm going to pause there because I said a few things that may have some questions on.
Yeah, as far as kind of like the process, you mentioned that we pay off the debt. Now we have that, the principal in the trust account. For you to say, if you want to go out and buy another commercial real estate asset, is it just with that principal equity, or can you then borrow that on top of that to buy something to leverage up, or does it have
So
to
it's
be?
both.
Okay.
It's both. Yeah. So let's just imagine you close it, Dwaine, it's your trust. And let's just say it's 10 million sitting in the trust, and now you're debt free and it's in mutual funds, and you find a deal tomorrow. Perfect. Up to 80% of the funds can be sent to a brand new LLC in which you're the managing member of, and you're partnering with your trust. And this is the key. By partnering with the trust, you are buying a new asset with new money, with a new depreciation schedule, and you're not doing a 1031. So you have none of the 45 days, none of the 180, but you're still tax deferred. So that's the key. We use an installment sale, which we can go into here in a minute about how this thing works. But essentially, yeah, it's very flexible. And now on that new property, you can receive debt too. You don't have to buy it all cash. You could put $8 million down and go buy a $20 million deal, which tying into the depreciation schedule part, this is really powerful, where if you would have sold, let's imagine you had a $10 million deal, Dwaine, and you've owned it for 27 and a half years, it was multifamily, or 39 years, it was commercial, and you're fully depreciated, okay? Meaning, if you were to sell and buy another deal right now, or let's even say you took accelerated depreciation, right, on your current deal, and you were to sell and buy another deal, well, the only depreciation you have is what's above your basis, right? I'm sorry, what's above your new purchase price, because you've already depreciated that first 10 million. So that $20 million deal you buy on a 1031, you only have an additional 10 million. Whereas the deferred sales trust, you buy that same deal through the trust, you have a full depreciation schedule because you did not do a 1031.
And how many times can you do that? Is that unlimited?
Yeah, and so when you sell that deal, what happens? Well, you can roll all the funds back into the trust and go do it again. Now, there's a couple things we have to be careful of. Mortgage over basis, okay, which is something the deferred sales trust does not solve. And so we got to be careful not taking on too much debt or doing too much accelerated depreciation, which could trigger that MOB is what we call it. But as long as we stay within those parameters, we can defer the tax and continue to, we call it rinse, wash, and repeat.
Oh, okay, cool. All right, so let's talk about kind of like the definition. I know we kind of talked a little bit parts and pieces of the deferred sales trust, and then kind of go on kind of the mechanics of how it works, and maybe we can talk about some examples.
Absolutely. Yeah. So let's talk about how it works. Let's just do, we're going to do me and you back and forth when you're selling your $10 million deal. And let's just imagine I come to you, and I'm a buyer myself, and I say, Dwaine, I want to buy your property for $10 million. Would you carry a note? Okay. And this, we're just going to explain right now the legality of this, in which, by the way, it's tied to IRC 453. So when anyone ever brings you a new tax deferral strategy, especially if it's making some big promises, you want to ask a number of questions. The first one is, what's the tax code? It's IRC 453. What's that? Well, that's just installment sale, seller carryback. You know it. Your owners, commercial real estate owners know it, and definitely their CPAs know it. And it's just we're based upon the carryback law. So let's walk through that. I said, Dwaine, I want to buy your property for $10 million. I'll give you a $2 million down payment. Would you carry a note for $8 million? As I say, you say yes. That sounds great. Now, in that scenario, Dwaine, how much actual receipt did you receive?
$2 million.
$2 million, right? Now, the other $8 million is in a deferral state, right? So you don't owe tax on that 8, but it's owed. It's just in a deferral state until and if I pay you back that $8 million. Now, what if I came to you and I said, Dwaine, I'm going to give you a 0 down payment. Let's just say hypothetically you said yes to that. And if you did, you carry a note for $10 million. But that 0 down payment, how much tax do you owe if you received a 0 down payment today?
Nothing.
Right. So you're in a deferral state on that full 10. Okay. So this is how we maintain non-actual receipt or constructive receipt. It's also, by the way, how a 1031 works. You may say, hey, Brett, I don't actually want to do a seller carryback. Just give me the full $10 million. But but actually go to escrow and cooperate with the 1031. I'm going to send it to a QI company, because once the money goes into Dwayne's hands in his personal account, that's when the tax is triggered. But as long as you 1031 and go use a qualified intermediary, it's not in your hands, it's in the QI's hands, of which you can perfect an exchange, correct?
Yeah.
So that's also how a 1031 maintains non-actual or non-constructive receipt. So that's the basis of this structure. Now enter the deferred sales trust, okay? The deferred sales trust essentially is going to buy your position with a 0 down payment and ask you to carry a note for that full 10 million. Why? Because immediately there's a $10 million buyer that we already have lined up that's willing to pay cash or with a loan, and they're going to put the 10 million into the trust. So we're going to walk through this slowly. So Dwayne, the trust gave you a 0 down payment in exchange for a $10 million note. So Dwayne, how much tax do you owe today if you received 0?
0.
You got it. Now the trust bought it for 10 million, your asset, and sold it for 10 million. So if the trust bought for 10 and sold for 10, Dwayne, how much gain does the trust have?
Yeah, no gain.
0, right? Therefore, no taxes owed.
Mm-hmm.
Now the buyer takes title the same way he would have, no difference. He's gone, and the funds are sitting in the trust. So I'm going to pause there because I know there's going to be some more questions of this, but do you understand what just happened right there?
Oh yeah, that makes a lot of sense there. Oh yeah, so we can kind of look a little bit deeper there, but I'm glad for you to kind of explain that, because I'm pretty sure, like, because me, I'm like a scenario based type of thinker. I got to kind of like imagining how it would work there. So okay, with the funds are in there. You mentioned the word partner with the trust.
Mm-hmm.
Can you kind of explain that? Who's this partner? I'm assuming, just based off my limited research, the trustee, who's that represent, and then kind of like what's the rules and kind of the background behind that.
Sure. So the funds are sitting in the trust, and you find a deal tomorrow, day 181, 5 years from now, okay? And by the way, you're the creditor in this scenario. The trustee is our company. We're the third party, unrelated trustee in it for business purposes, how we maintain the integrity of the trust. So you become the creditor. The money is owed to you, but you have all the rights and protections of a lender, meaning the funds never move without your signature. The funds are held at some of the largest banks in the world: Bank of New York Mellon, Charles Schwab, TD Ameritrade. And the key is the funds only ever move with your signature, okay? So the trustee can't take the funds. Now, you may find a deal tomorrow, and you are maybe looking for partners, okay? And you form a brand new LLC, and you may bring in your other friends or other partners, but you may just say, you know what, I just want to partner with my trust. And okay, you can partner with your trust. Up to 80% of those funds can be used to partner with you in that trust. Now, $8 million sitting in the LLC, of which you're an 80% owner, and the trust is a 20% owner. But the trust is a silent partner, meaning it put up 100% of the down payment, and you, Dwayne, put up 0 personally of the down payment. Okay, but you personally, Dwayne, are an 80% owner. And this is the key here, right? We maintain tax deferral because we're just partnering with the trust. So it's just like you're partnering with somebody else, and Dwayne, you're doing all the sweat equity. You're finding the deal, you're adding the value, you're negotiating with the tenants, you're running the management, all of that. You're running the whole deal. But the key, you just had a silent partner that happened to be a deferred sales trust, of which you were the lender on. So the funds are in the trust now. You buy a deal the same way you would have. You own and manage it the same way you would have. But you have this partner you need to pay back. Now, they have a preferred return, which typically mirrors the note. The note is generally a 10-year note, of which an 8% return. After fees, about 6.5%, and that's after paying the financial advisor and the trustee. But once that happens, the funds are funding you. So after it pays, then it can pay you, and you're going to pay ordinary income tax on that. But let me slow back down. You're back and you bought that deal, and you're owning it. You pay back the preferred return to the trust, and then the next 80-20 goes to you, Dwayne, 80 to you, and 20 after that. Now, you add value, you sell it in 5 years for a $2 million gain. Okay, what happens? Well, you got to pay back the trust, the original money, plus the preferred return. But after that, after the next part, 80-20, 80 goes to Dwayne, 20 goes to the trust, of which you can roll it all back into the trust. So we like to say we eliminate the need for the 1031, right? And we provide more flexibility and solutions to capital gains tax deferral that other products just don't offer. But we're using 90-year-old tax law. We're using just a regular JV partnership with the brand new LLC to get a new depreciation schedule and to maintain the tax deferral.
Is that based off of any type of asset that you decide to go into, that you have to form it in that way, the 80-20 preferred return? or is it for certain types of deals, or how is that? Because I'm just kind of thinking like the average person saying, okay, I do an exchange, and they just kind of just go into the new replacement property with the deferred sales trust with the kind of new kind of nuances. Is that just what the cost is?
Great
Or
question. Really flexible, really flexible. So let's talk about the big demographic shift that's going on right now. So according to the American Bankers Association, there's about 17 to 20 trillion dollars that will pass from one generation to the next and the next 20 years. And this is known as the baby boomers. It's the largest wealth transfer in the history of the world. And they own three major assets that are highly appreciated: high-end primary homes, high-end or highly appreciated commercial real estate, and highly appreciated businesses, private equity. Okay. And in fact, there's about 77 million baby boomers in the US alone. And every day, about 10,000 of them are turning 65. And they're faced with toilets, trash, liability, employees, and they've made their wealth and they want to retire from all of it. But they have 30 to 50% that's going to be wiped out in capital gains tax depreciation recapture when they sell. And so they want to be passive, or they want to diversify, or they want to give up the management. They want to trade it for time travel and everything else. And they don't want to go through the '08 crisis again. So once the funds are in the trust and once they're all tax deferred, it works for all of those assets. They can essentially put it into anything. What can't they put it in? They can't put it into a primary home. They can't day trade by themselves. It needs to stay within the US. Most of our clients are going to go into a balanced portfolio of liquid investments, and then a balanced portfolio of commercial real estate deals, either of their own or with trusted operators and owners that they know of, right? As long as it's within the US. But it can be ground up development. It could be existing cash flow deals, right? As long as it fits their risk tolerance, and that's the key here. Before the funds go anywhere, they fill out a risk tolerance questionnaire, and that becomes the constitution for how and where the funds are invested. And based upon that, there's allocations assigned for different product types and different opportunities. And as long as it's in that risk profile and not keep putting too much stress on the trust, then it's very flexible.
And as far as kind of you had mentioned more passive. So would that exclude businesses that require, manual labor by the? I mean, of course, a lot of people be going the opposite direction if they're, selling business or selling that type of asset. But does it include that, or does it?
It's both. So it can be an active deal. So you don't have to go with an operator, right? You could still buy and own real estate the same way you would have, and
Gotcha.
you've always done it. The only difference is it's going to be 80% of the funds versus all of 100%. And why is that? Because there's a reserve. We want to make sure we can pay the trust and we can service the debt because it is owed to you. And we don't take on too much risk on one single trust. So track record is 23 years, thousands of closes, 14 no change IRS audits, not one single issue with the trust. And also every advisor has been able to, and we have thousands of financial advisors across the US who have signed up with us, and commercial real estate brokers and syndicators and CPAs and tax attorneys. And we don't want it to fail. We don't want anyone to not get paid. Now, we can't control that because it's based upon the investments. But again, if we can diversify, if we can get somebody out of debt, we can give liquidity, and if we can give optimal timing, we're reducing the overall risk. But if you want to just buy deals yourself, you can do that. If you want to do fix and flips, you can do that. Right. But the key is with that 80% of the funds. Now, when I say buy it yourself, I mean, you form the LLC, you're the manager of that LLC, and you just partnered with your trust, but you're making the decisions for that LLC and you're paying back the preferred return. But it's versus maybe somebody who just did it all themselves in their own LLC, no partners. You're just adding that one little partner who's funding the deal, which happens to be your money. Hopefully that makes some sense.
Oh yeah. And then it's kind of got to go a little bit more detail as far as kind of the partner, the trustee, as far as like what is like kind of typical process. They speak with you, have a consultation, they say, okay, I'm gonna move forward. Is there initiation fee? There's asset management fees or stuff like that.
Yeah, let's talk about the process and let's talk about the fees. So first of all, we only get paid, and that's the tax attorney, and that's my company, Capital Gains Tax Solutions, as the trustee and the financial advisor, if the deal closes and if they use the deferred sales trust. But we will do the education, we'll do all the preparation, and we will work with trusted advisors and educate really everybody. And if they decide not to do it or it doesn't work out, no problem. We're not owed anything. So that's the first thing. Second, yeah, you just set up a one-on-one call with us, and we have a deferred sales trust calculator. You can go to our website at capitalgainstaxsolutions.com, and you can answer 12 questions, and that's going to give a side-by-side comparison of pay the capital gains tax or use the deferred sales trust, and that's going to establish what's the liability. Is it worth it? And just give you some rough numbers. For every 100,000 of liability, we need about $500,000 or so of proceeds. So if your deal is smaller than that, we say just pay the tax. Or if your liability is smaller than that, just pay the tax. Also, the ratios have to make sense. If you're selling a $10 million deal and you only have $300,000 in tax, just pay the tax. It's too small. But if you're selling a $10 million deal and you have a $4 million tax bill, okay, that's substantial, right? That's 40%. So the ratios have to make sense. But essentially, we get on, we find out your goals, we find out what you're trying to do, what you're trying to solve, and then we say, okay, here are the benefits. By the way, one of the major benefits, too, for your ultra high net worth individuals who are listening to this podcast, and that means anyone above 11 million single or 22 million married, is what's called the estate tax challenge, okay? So in a 1031, you can defer the capital gains tax and you can get the stepped up basis when you pass, and your kids can. But it has nothing to do with the estate tax. There's a whole separate tax, which is 40% of whatever's left inside the taxable estate above and beyond the exemptions. So for example, let's imagine someone's worth $52 million and all 52 million is in the estate. Right now, if they're married, 22 million is exempt, but that 30 million that's remaining is going to be hit with a 40% estate tax unless and if the funds are moved outside the taxable estate. Mm-hmm. Now, the intent is to get it outside the taxable estate. The problem is it takes a long time and or gifting, you run out of time to do it. Meaning you can give small amounts into what's called FLPs, but eventually you either run out of time or you run out of exemption to get it all out. Whereas in the deferred sales trust solves that in one single transaction. Let's imagine you had a $30 million portfolio you were selling. We can move it all outside the taxable estate, defer all the capital gains tax, which would mean we save your heirs or the estate 40%, that 12 million. So nothing else we know of does that in that efficient of a way and one single transaction. So, but back to what we're talking about here. We're going through the process. So we gather all those facts. We gather all those facts and say, here's the tool. How do you want to use it? And that's really our goal. Our goal is just to educate, and we're just the guide. And honestly, I'm just kind of like the nurse, Dwaine. I just take the pulse. I'm not the expert. I'm not the CPA or tax attorney. I take the pulse and I say, hey, you might need capital gains tax surgery here. But before you do, you want to bring in your brain surgeons. Who are those? Those are the trusted advisors you've worked with for years, your CPAs, your tax attorneys, and have them talk to the brain surgeon over here, who's the deferred sales trust brain surgeon, and make sure you get the blessing before moving forward, okay? And if and when you do, great. We'll move forward, we'll close, and a lot of those advisors then join us after they see the value we're bringing to them and their clients. And that's it. We close at escrow. It's kind of like forming an LLC. It's some extra paperwork. We're forming a trust. The trust has a new EIN. As far as the investor, they just get a 1099 based upon the income they're receiving. They're going to pay ordinary income tax on that. Mm-hmm. And then the trust, my role as a trustee is to file a tax return on behalf of the trust to make sure we're reporting that all accurately as well. Now, in regards to the fees, how much does all this cost? Remember in the beginning, I mentioned about 1.5 points. That's the ongoing recurring fee, generally speaking, based upon how and where the funds are invested. There's a one-time upfront cost, which if you for the tax attorney, it's 1.5% on the first million, and then 1.25 on anything above that. So let's just say it was a $3 million deal. The first million would be 1.5%. The remaining 2 million would be 1.25. Now that includes legal and the tax structure, but also includes audit defense for the life of the trust, which is key here. There's other structures out there that may or may not offer audit defense. That may or may not offer have the track record of the IRS closes, and so you got to be really careful with what happens if somebody audits this. And we're going to protect you. The tax attorneys are going to protect you on that, and they're also going to defend that at no additional charge. So that's the tax attorney fee. The trustee fee is about 50 basis points. So that happens at close of escrow, and then it happens once a year thereafter, as long as it's with a financial advisor. Now, if you go to a real estate deal, outside deal, then that's going to double to about 100 basis points. Although the financial advisor is no longer managing the funds that went out. So generally speaking, our notes earn 8, but after fees of either paying the financial advisor and the trustee, it's going to net about 6.5. Now, The bigger picture is at the end of 10 years, the goal and the obligation that we're trying to shoot for is that 8% net of all fees to the client, okay, to the note holder. And so, although the cash flow is about 6.5% along the way, and but at the end of that 10, we want to try to hit that 8. Okay, you can renew it at 10 years and renew, pass it on to your kids. So, and essentially, you can let this keep going for as long as the laws allow.
Hmm. Yeah, that kind of sums up a lot of the other questions I had. So that's great. The one question that popped in my head, and it came up from our first conversation regarding some of my 1031 exchange investors, was the concept of saving a failed 1031 exchange. Can you kind of explain that? That's pretty interesting.
Yeah, great question. Yeah, we can save failed 1031 exchanges, and we've saved many failed 1031s, and we're seeing more and more of these. Okay, so back to remember the guidelines for 1031. It's 45 days to identify, 180 days to close. And so let's just say it's day 170, and your properties aren't going to work out. There's no chance of closing them. What do? Well, we have QI companies, qualified intermediaries, who will cooperate and have the funds sent to the trust. Now we add some language into the exchange agreement that seller has the to the right. It's called defeasance language, the right to be able to move into the trust versus just taking actual receipt. And so yeah, that's it. So that's the key. And like escrow at close, instead of sending it to you, Dwaine, directly, they can send it to the QI, or they can send it to the deferred sales trust. Now, once it's with the QI company, what they can do? They can send it to Dwaine, or they can send it to a deferred sales trust if the other options of the properties don't work out. The key is you need to work with a QI company who will cooperate, because not every QI company knows about this or has approved of it for whatever reasons they have. But personally, I send all of my deals to a QI company to give both options for all of my clients, just in case, right? Because and also, here's a little caveat: it doesn't take one of the replacement properties. It's not like you're identifying a deferred sales trust, therefore you only have two slots left.
Mm-hmm.
So there's no downside to having it as an option. Only upside. Remember, we only charge if you use the trust. So everyone, if I'm in their shoes, should have this as an option. Should have it ready to go just in case.
Yeah, that makes sense. So it really comes down to just finding a QI that's compatible with this service. Are you seeing a lot of the major large QIs have this, or is this kind of a select few? And the question is, why not? I mean, even if if it could just sit there as a backup at the very least,
right?
Like I said, a lot of my clients would be more intrigued by this, because now it's like, because someone would say, "Oh, I have to put this." They just kind of get confused by it. But having it as kind of a slot there to say, just in case something happens, you can use it, even though that should maybe be your primary choice. But like I said, it's the really question is, why aren't most QIs having this ability?
Yes, and the other point one to that is, why hasn't my CPA told me about this, right? And so it kind of go hand in hand. I think people have their until something becomes mainstream. Generally speaking, they just focus on what they're doing, and most QI companies are just doing 1031s. They're not doing brokerage, they're not doing management, they're not doing deferred sales trust, and they're just focused on that niche. Now, they may have had their attorneys look at it. I can't speak for all the individual QI companies. I'm not an attorney, so maybe they have some issue with it. I don't know. All I know is the tax attorney who's done thousands of these has had zero issues. Not one single IRS audit has failed, and thousands of closes. The largest deal was 125 million in San Diego. So which was audited, by the way. And what the IRS said was, you guys are just doing an installment sale. Now, you're being creative on how you're using this trust to make this thing work. But as far as the QI companies, those that have, I can tell you they're getting a lot more business, right? Because let's say either way, they're attracting the client because they have the option. So yeah, that would be the answer to that. And as far as the CPA part of it, most CPAs, especially even if they're real estate CPAs, they're in their own niche here. And I imagine it to like a general practitioner or even like a knee surgeon, right? If you go to a doctor, they know knee surgery and they know general practice, but they don't know brain surgery per se, right? They're going to put you to a specialist. And that's where the tax attorneys who started this, that's all they do is a deferred sale. They're a brain surgeon, and they've never lost a patient. No patient has ever died, right? No patient's ever gone to jail. And it just works. And so sometimes the client needs to say, look, you've been a good CPA general practitioner, but I've got to get brain surgery here because you're not paying this $1 or $2 or $4 million tax bill. And sometimes the CPAs don't want to say necessarily yes per se because they're concerned that they're going to be held liable and there's no real upside for them. So some of them will say, well, I'm not sure. I understand all that. And no, you're probably not going to understand all that because you haven't done 10 of these or 5 of these or thousands of these, right? And so that's when the client has to say, okay, I'll make a decision. But by the way, it's not to say that we don't have CPAs who have said yes. We have national law firms who have said yes. In fact, we have thousands of professionals across the U.S. We've rolled this out to thousands of financial advisors, and their legal teams had to look at this before we rolled it out to them. So there's been lots of eyes and ears on it. We've already blazed the trail. So we would just say, take it slow, get to know us, introduce you to your trusted advisors. Let's all talk and let's find out what challenges they have. And most of the time they say yes, go for it. But sometimes a QI company will say no. Sometimes a CPA will say no. And then that's when the client has to make a decision.
Yeah, the key is just the education. Podcasts like this, your podcast, seminars, webinars, just getting more information out there to see that, do you have these options available? Like I said, I'm just kind of amazed on the flexibility and the things that you can do outside an exchange, which could, possibly just save you, like I said, just on a tax basis, but just like I said, the flexibility, the different types of assets you can do, the debt replacement requirement rules, and all those stuff is such benefits that you can, utilize. So, this is great.
Yeah, we say so. You eliminate the need for the 1031, but if you can find a 1031, great, go for it.
Mm-hmm.
But look at us as an alternative if you're looking to retire, downsize, or even for syndicators that are out there, right? They have carried interest. A lot of syndicators are bringing a bunch of money, Dwayne, and then they'll add value, they'll sell, and they'll pay $1 million in tax themselves because they're not doing a 1031 with the entity. And then they just go do it all over again. Well, the deferred sales trust is great. They can have their own single deferred sales trust, and then the other 10 partners don't have to do anything. They can just pay their tax, or each of those partners could have their own deferred sales trust. So in other words, the entity doesn't have to move. It's a very clean way for partnerships to exit and go their separate ways, have their separate accounts, have separate financial advisors. Okay, they can have their own financial advisor with their separate risk tolerance. And the key is it helps to sever a partnership where most 1031s, the whole entity must stay in place, meaning it has to travel together. And sometimes that doesn't work for partnerships, right? People have different needs and different things. So yes, it's very flexible and a nice alternative to a 1031.
Awesome. Yeah, it was so much information. And like I said, maybe we have to do like another follow-up, just kind of get a little bit deeper into it. Before the audience would love to get to know a little bit more about you. So kind of what's a typical day for you? And do you have any specific special morning routines?
Yeah, so I'm in the business of education. So Steve Jobs has a great quote. He used to tell all of his employees, I never want you to sell. I only want you to educate. And that's really our passion. It's just empowering you, the business professional, the commercial real estate owner, commercial real estate syndicator, with this tool so you can help your clients create and preserve more wealth and so that you can grow your business, right? And so I like to work on a team. So I'm just constantly educating. We're doing an event in Palo Alto with the number one or top realtor for the last 25 years. He sells about $100 million here on Thursday every year in high-end primary homes. He's using it for his own home, and it's a $14 million sale. He's going to defer about $2 million in tax, and he's spreading it out. So, I speak at events like that. I speak in front of financial advisors. I do webinars. I'm launching my podcast. I'm on podcasts. So it's just communicating this, right? And then I also have my team. I also have commercial realty apartment advisors, so I do some brokerage as well, apartment complexes, some retail 1031s as well when it fits. And so, yeah, that's education, running a team, and then of course being a dad and a husband, and playing basketball when I can.
Awesome. Yeah, I always ask my guests, what are you most grateful for?
Yeah, I'd have to say. First, it's I'm a Christian, so Jesus and what he did for me on the cross, and then all the blessings he's given to me with my family. So he's blessed me with 5 amazing kids, ages 1 to 9, and a beautiful wife, and who just supports, loves, and encourages me. We're a great team together. Plus family, of course. Sorry, my alarm went off there. Plus family. And I'm also, I'm 36 now, and I still have, pretty good health. I can play basketball. Basketball is my passion. Someday I want to coach college or high school basketball. And so to be able to be still part of that is a big part of what I'm grateful for.
Beautiful. Lastly, how do we get in contact with you? This is great stuff. So we want to send the listeners to your website or phone number, whatever information you want to provide to us.
Yes, thanks. So Capital Gains Tax Solutions, you can search that on YouTube, Google, right? It's capitalgainstaxsolutions.com, Bigger Pockets, Facebook, LinkedIn, and then also any of your listeners reach out to me. We'll give you access to free webinars that you can watch and really see this broken down and dissect it with the arrows, and you can pause it and replay it, and really absorb it versus just this quick podcast here.
Beautiful. Brett, thank you so much. It was wonderful information. Like I said, just kind of blew my mind. Like I said, we'll probably have to get a little bit deeper in another day. But again, thank you so much. Have a blessed week and look forward to connecting with you soon.
Thanks, Dwaine.
Take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.